Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of Coca Cola, ticker symbol KO. This continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average with the ultimate goal of taking those companies and trying to build a great portfolio. This is the 8th video in that series, and you can see a link to the playlist in the description below. So for Coke, we're going to look quickly at their operations, and then we're going to dive into some recent developments. So Coke owns and licenses more than 500 non-alcoholic beverage brands worldwide. Now, they break out their financials in a few different ways. First, they break out operations by geography. They have North America, Latin America, then they have Europe, Middle East, and Africa together, and then they have Asia Pacific. The European geography, well, that accounts for the largest volume as far as unit cases with 30%, then Latin America with 27%, Asia Pacific with 23%, and 30% in North America. In Coke's last annual report, they segmented their beverages into different categories. They have sparkling soft drinks, water, enhanced water and sports drinks, juice, dairy and plant-based beverages, and tea and coffee. And then they have energy drinks. Then finally, Coke also breaks out their bottling investments. Okay, so Coke sells beverages. We know what they do. So, interestingly, here's Coke's revenue since 2008. And as you can see, since 2012, it hasn't been very good. Revenue has declined for 6 consecutive years, and as expected, free cash flow has followed right along. But here's something interesting. That black bar, that's the past 12 months. That's the last 2 quarters of 2017 and the first 2 quarters of 2018. And we can see that's still declining. But for some reason, these 2 green bars, these are analyst expectations for 2018 and 2019. Now, it's important to remember that the left bar is 2018, and 2 of those quarters are already in the books. They're already done. So once I saw that, I was surprised, and I wanted to see what analysts expected to happen to revenue. So I went back. Here's the new revenue chart. And as you can see, analysts think that revenue is also going to turn higher, just not nearly as much of a jump as they see for free cash flow. Now, I get this data from Bloomberg, and I can see that free cash flow projections are an average of 6 analyst recommendations over the past few months. Revenue, on the other hand, is the average of 23 analyst recommendations. So I'm going to bet on the turn higher being broad consensus, although I'm not 100% sure that the extent of the jump in free cash flow is really the way it's going to play out. So we'll get back to our expectations in a minute. But for now, let's look at what happened, and then we can try to see what we think will happen. So back in 2010, Coke bought the North American bottling business. That business traded under the ticker symbol CCE. Now CCE is called Coca Cola European Partners, and they're basically the bottling company over in Europe. So since they acquired that company, management has been working on what they're calling refranchising. And at the start of 2018, it seems that they were mostly completed with that refranchising. Well, this refranchising was a real time drag for management, and it forced them to move around the business and try to reshape the future of Coke. Now, in the recent investor presentation, here's how management mapped out their operational priorities. First, they're going to push their leading brands. For example, Coke has recently introduced Coke Zero Sugar globally, and they've launched more than 500 new products. And I know that sounds like a lot, but this is in line with the new strategy that they're calling the test and learn approach. And to me, this actually makes a lot of sense. This strategy seems to be in line with the way business is done these days. A company puts together what they deem to be the basics of a product or service, and then they push it out to the public and see if the public likes it. If they like it, great. They tweak it and make it better. And if the public hates it, great. You can scrap the project and it doesn't really hurt you that much. Okay, I like that. That seems to make sense to me. Their second focus is on margins. For example, they're hedging away from water, which is a low margin business, and they're trying to focus on higher margin businesses. That makes sense. Third, and that is to improve what they call their core strengths, things like their massive distribution network. That's where their refranchising plays in. They completed their US refranchising, the one we mentioned before, but they also did the same thing with their China refranchising. Okay, then their fourth point is to digitize their whole system. And yes, that makes sense, digitize. That sounds like a better plan like 10 years ago, but sure, let's do it now. Better late than never, I say. And I also get that Coke is huge, and that they've been operating the way that they've been operating for a long time. So I understand that perhaps it took them a little bit longer to jump on the digital bandwagon. Plus, they operate all over the world, so I assume technology is less accessible in some areas. I don't know why they haven't done it up to this point, but great. Digitize the system. That's a good plan. I like it. That's number 4. On to their 5th point. And that point is what they call unlock the power of the people. And at first, I rolled my eyes when I saw this one, because to me, it sounds like the same business lingo you hear from every major company when revenue starts to struggle. But then, Coke has done some interesting things. See, a lot of these points came out, a lot of these transition points on how they're going to shift the business came out in 2015. And at that time, they replaced the CEO, and they also created a job called the Chief Growth Officer. Okay, if nothing else, that's a unique name and seems obvious what their role will be. But they've made some dramatic shifts to personnel in general, but we'll get more to that in a second. So Coke is also saying that they're trying to become a more capital-light business. Well, if they do a better job of controlling their distribution and, in theory, improving their capital expenditures, well, then I suppose it's possible that the shifts in the business of, let's say, trimming down operations, if you really can become a more capital-light business where you have a less capital-intensive, less capital-costly business, in theory, you'd have lower capital expenditures, which could cause free cash flow to move significantly higher. Perhaps that explains the dramatic jump that we saw in free cash flow versus a dramatic jump in revenue. If you cut expenses, revenue wouldn't really change that much, but it's very possible free cash flow does. Along those same lines, management has done what they can to control costs and improve efficiency throughout the whole organization. In addition to shifting around management, this chart, this is the point I was making a second ago, is the number of employees over the past few years. And as you can see, they appear to have gone a bit nuts when it comes to cutting employee costs. Now, this could be a good thing from an expense standpoint, but it could also be a bad thing if they go too far and end up hurting operations. And this brings us to a different piece of news. So, just recently, Coke announced the acquisition of Costa coffee from a company in Britain for about £4 billion, which is about $5 billion. Costa generated about $1.7 billion in revenue over the past 12 months, and they have over 3,200 locations, plus a whole bunch of self-serve locations. Now think back to the points that they made before. They're trying to push away low-margin business, pursue higher-margin business, pursue businesses that have greater growth. Now, Coke has made it clear that this is a strategic decision. This helps boost their presence in the hot beverage segment, which is one of the fastest-growing beverage segments in the world. And there are only a few large coffee players. Coke believes that if you pair their enormous distribution capabilities with a solid coffee brand, that they believe that they can get Costa to add significantly to their business. And I personally think that this is a good move. Given what they spend and given the upside, risk seems to be limited while the upside seems significantly higher. Okay, so now the question is, what is Coke worth? And should it make our ideal portfolio? Well, when I first started researching Coke, I really want to use discounted cash flow for 2 reasons. First, it's my favorite. And second, I figured that Coke would be the ideal candidate since I assumed that free cash flow would be somewhat predictable for such a long established company. Well, at this point, I can safely say that it appears that they're in a transition period right now, and free cash flow may not be quite as predictable over the next couple of years. That being said, I think it makes sense to try to value Coke using a comparables method like price to earnings multiple or EV to EBITDA. Now, personally, I like to start with consensus estimates. So if we're looking at the PE multiples, consensus has 2018 earnings per share as $2.08 per share. In 2019, they have EPS as $2.23. Currently, Coke is trading at a forward PE multiple of about 21 times, while the market is trading at 17 times. And if you look at a competitor like Pepsi, well, Pepsi is trading at a forward PE of about 18 times. So it looks like Coke may be a bit high relative to the market and relative to Pepsi. When I look at Coke's 3-year average for their forward PE, well, it's about 22 times. Their five-year average is 21 times. So it looks like Coke has been trading right around where they have been historically. And with Coke trading at about $45 a share, it looks like they are right near their fair value based on PE. Well, I also went ahead and checked their EV to EBITDA multiples, which is enterprise value to EBITDA, and that also looks the same as PE does, like Coke is trading right where it should be right now. So the real question for us is, should it make our ideal portfolio? And what I've realized is that we're probably going to end up with multiple ideal portfolios. To me, it makes sense to have a value portfolio, a growth portfolio, a dividend portfolio. By the way, Coke's dividend is almost 3.5%, which relative to the S&P's less than 2%, makes their dividend quite good. So at the end of the day, I think that from a dividend perspective, I think that Coke is probably a great addition to a dividend portfolio, especially if free cash flow and revenues start to turn higher. From a value perspective, probably not so much. At this point, if they ever had a dip down or if something ever happened with the market or if revenue significantly started growing, then perhaps we could say that they'd be a good value opportunity. As far as them making our growth portfolio, I'd say the same question remains. Does the turnaround really happen? Does free cash flow really jump? If that's true, then perhaps if they really started picking up if this Costa coffee really added to growth, it's possible. Either way, I think Coke is an interesting company and something we're going to have to watch closely. To me, I think that they're an ideal fit in a dividend portfolio because they have such an enormous business. They do have an opportunity to grow, as we saw with some of their things, specifically free cash flow. And I'd love that in a dividend portfolio, but I'm not sure about the value of the growth portfolios just yet. My question to you is, what do you think? Did we miss anything huge with Coke that you think that will make it better or worse? And if you've made it this far in the video, I appreciate you sticking around till the end. And if you haven't done so already, hit the thumbs up and don't forget to subscribe to the channel. And I'll see you in the next video. Thanks. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.